Nvidia invests $5 billion in a chip maker. Interest rates are cut, and the S&P is going up and down. Fundamentals are volatile. Fellow traders, ladies and gentlemen, good to see you again. How's it going? Hope everyone's well. Welcome to the live show with Rob. We're back, and we've got the live show going, and we can have a bit of fun again. We can have a little bit of fun. Just remember, trading's risky. For those of you who don't like risk, don't trade. That's quite as simple as it gets, really. Hope you guys are all well. Hope you guys are all making money. I hope you guys have all done some good trades. Our UK 100, our United States dollar, our Nikkei, and our Spain, and a couple of others all got traded out in the volatility for a profit, which is fine. The profitable stop losses were all knocked. But that's how it goes with these Fed meetings and interest rate cuts. So that's the first interest rate cut of the year. And even that wasn't good enough to send the markets to the moon. They're still in their normal spot, hanging on, waiting for something to happen. There's always a little bit of background information which says, yeah, that's all great, but that's always the case. And clearly that's the case again. That's always the case with these volatile markets and the information that comes out. So you get this spike up and down every single time, which is why I don't hang my hat on these kinds of news events. I don't hang my hat on things like interest rates and jobs figures and that sort of stuff. I've got bigger fundamentals to think about. But on the small fundamentals like this, I know there's always, the information's always baked in, the rumors come out and everybody gets all excited about the interest rates getting cut. And then everybody buys. And then when the interest rates do get cut, nothing happens except a little bit of volatility up and down. And then everybody says, yeah, but, think about this. And then it doesn't go anywhere, or it goes down, or whatever the case, which it did last night, by the way. It went down a little bit. So nobody was that excited about it because it's all baked in. The big problem comes in is if what was expected doesn't happen, then you get the big problem. Then you get the big issue, because then it really crashes down and goes the other way because everybody's expecting something to happen and then it actually doesn't happen, which is always fun at the end of the day. But the real impact of these fundamentals on these charts is minuscule at the end of the day. It's not that big unless there's something really big. How's it, Danny? Keenan, hello. And hello, Alex. It's good to see you guys. Welcome, and it's good to see you guys already. Absolutely. It's a beautiful Thursday afternoon here in Cape Town. Lovely day. Sun's out. Well, for us, spring starts on Spring Day. The 1st of September is Spring Day for us. But Cape Town tends to remain a little bit cold most of the time. Cooler, not cold, cooler. And then we get a beautiful summer running right through. So we're running into summer now. We'll go through summer into Christmas and through and into the next year. So it's a beautiful time here at the moment. If you go north of the country, it's insanely hot. It's a completely different ballgame. But I have lived in different parts of this country, and I know the different temperatures and how hot they can get. There was one place up in the north that I was measuring the temperature outside. I used to have a shop at one time, and I was measuring the temperature outside in the car park, and it was around, and in the car park, to be honest, and in the sun, it was around 60 to 70 degrees Celsius, which was, you couldn't stand outside. But in the shade, it was over 45 or something like that at that time. That was hot. We never reached those temperatures in Cape Town, fortunately. How's it, Blue Mango? That's good to see you again. Lovely to have you on board. So, yeah, the Dixie has taken quite a knock. It has gone down quite a bit. I mean, if I look at it, let's just quickly have a look at it, and we can just take a wee peek on what's going on there with the Dixie. If you look at it, it's all the way down. It's come down, and it just seems to be sort of swinging around at the bottom here at the moment. I did note to you guys that I see this curve on the 50-day moving average turn around, maybe going back up. So the Dixie seems to be hitting a bottom here. Could this be a double bottom? Could this be the end of the Dixie falling? Well, we'll see. We'll see how that goes, because it is obviously affecting my South African Rand trade one way or another. And then the VIX is at the bottom, and it's probably going to be at the bottom. This is a weekly chart, and it's sitting at the bottom. And if you look at the distance between these spikes, I think you've got a bit of time before the next spike before you have to really get into it. But if you want to get into the VIX, just remember when you're holding it, you got to pay for holding it, so it's not free. Nvidia's all the way at the top, staying there. And what's in the news? Nvidia bets big on Intel with a $5 billion investment. Just give me the $5 billion, man. I'll just enjoy it. That's fine. Gosh, Moody's flags risk in Oracle's $300 billion pile of AI deals. China drops Google antitrust probe during US trade talks. The antitrust probe, yeah, that's always the thing. Our nuclear power could be a $10 trillion market opportunity. So back on nuclear power again, are we? That's fantastic. So many things to look at. Anyway, first interest rate cut. There we go. That's the news for the week. That's been pretty interesting. Let's see, what other trades have we got on the go? Oh, yes, I did mention that I thought gold was going to go short. Well, guess I was wrong. Seems to be wanting to go long here. Look, it's on a resistance. It had broken through, broke back through again, but there was a red candle below this trend support this morning, but it didn't close. And I did say wait till it to close, and it closed green. Oh, well, that's useless, isn't it? So you can't really take the trade. Now you've got a green candle popping off the top of it, so short trade is gone for the time being. But we'll wait and see what happens. We'll see if it comes back. We can't be right all of the time. I do try to be right all of the time. And everybody tries to be right all of the time. Just about everyone anyway. We all think we're going to win every trade, but unfortunately we're not. Are we? We're not. Yeah. Okay. Hope you guys all can hear me and everything's going fine and you're all in the right place. Hopefully nothing's going wrong on the other side. Because I did make some tweaks and I'm hoping that nothing's gone wrong in the system. So if there is, just let me know. Bitcoin is on the up. Look at this. Look at Bitcoin. Seriously bullish, heading on the upside, going towards the 120 and breaking through levels. Yeah, I think if gold holds, we may still possibly go short. I'm just waiting for it to see what happens. You know, there is a level here. There is a big resistance level here. Let's see what it does, because look at the trend support as well. It's right there on the resistance. That's a very tight move. So if it gives us a red candle off of that resistance through that support, closes, then there's a good likelihood that we might still get the short on gold. So keep an eye on it. Doesn't mean it's completely gone. It just means that it didn't work out earlier. I thought it would have worked out earlier, but it didn't. And we'll just keep an eye on that and see where she goes. IOTA battery passport market to reach $735, driven by sustainability mandates and digital supply chain transparency. Proctonglos. Okay, lovely. You say so? Lovely. Euro, Great British Pound. Euro, Great British Pound. I actually changed a few things on the chart here. I changed a few small things on the chart here. Nothing massive. You'll notice that I did have the trend line in here, which had broke through and went up. So that was a clear signal to go long. And then I did have some trends at the bottom here, which I've taken out because that's changed. And I changed the demand level slightly because that's moved. It's down here now. If it comes down, it takes money here. So we just got to keep that in mind. But what the main thing I've done is moved this trend up here. The main trends. There's a bigger trend here than we think, and it's running all the way through here. So it looks like it's more, even though that was seriously bullish, it looks like there may be more bearishness here, which gives us this supply of money as well right on that point, which means it could be going up to take that money and then dropping. So this could end up being a short, the Euro Great British Pound. Keep that in mind. The Euro Great British Pound may end up being a short somewhere at the 86.9. Looks like it might come up to take that money, and it could be an interesting trade. So just watch out for that. And it's a useful trade as well. Obviously very useful. A lot of this is very dependent on how the US dollar decides to go, how the US markets decide to go. We were short on the UK 100. It paid off beautifully. We made some money because I brought the profit all the way down. Went, spiked it out, took that trailing stop, but that's all good. You know, it's a good profit, but it was a nice short. But I think the short's run out of steam and it's turned around, gone up. But there's the red candle coming in again. So are things turning around again? Are things getting a bit iffy in the market? Very possible that things are starting to get just a little bit iffy in the market again. It is Coffee with Rob, so let's have some coffee. While we wait for Shane, who's coming along as well, I'm sure. Oh yes, Blue Mango, you like to trade gold, eh? So you should know quite a lot about gold and how it trades and all the rest of it. But I mean, you can also trade the silver with it as well. But I think the gold's better. Yes, I was looking at the Bitcoin here, and I was just thinking, the Bitcoin is bullish. It's going up, and it does appear to be heading for that 120. But while we're here, what about the ETH? The ETH has been running fine, and it's running at a nice little level here. Yeah, this does appear to be quite an interesting little guy here, sitting in this range. It appears to have shot all the way up, hit that 47.95, come all the way back, gone all the way back up again, and sort of swinging around. There's a bit of a cup and handle developing here. It looks like this might just shoot to the upside from here. So keep your eye on ETH as well. But BTH as well seems to be going up, seems to be going to the 120. I'm not a big crypto guy, but keep an eye on it. You never know, you could get a trade. I like to get the odd trade. So I had questions, and one of the interesting questions that I had from a subscriber was, how many trades do you take if you trade on the 4 hour? How many trades do you take per month, per year, per week, per day? I don't know. How many trades do you take if you're on the 4 hour? Now I know if you're on the 5-minute charts, you're probably going to need to take 5 to 10, 15 trades a day. I've been there, done that, traded the 5-minute charts. It's insane. In and out, in and out, in and out. And just remember this one thing if you're trading, and the one big thing if you're trading to understand is trading costs money. So every time you take a trade, you pay. You pay for every single trade you take. So keep in mind that day trading is more expensive than swing trading if you're taking less trades. But the thing to understand about trading is don't trade based on how many trades you take, because if you do that, you're limiting yourself. You're limiting yourself to, if I don't take that many trades, I'm going to have to force some trades because I feel like I've done nothing and I haven't taken any trades. So I need to take some more trades. And this is where one of the big issues comes in the market is, now you're saying to yourself, I have to take 10 trades. And if I've only taken 8, well, I'll have to take another 2. Excuse me. Won't I? I'll have to take more trades. And that in itself is a form of insanity. You don't want to do that. You want to wait for the trades to come to you. So what I always say to people when they ask me how many trades do you take, particularly now that you're swing trading rather than day trading, is I'll take as many trades as I possibly can. Now, bear in mind that I have more than one brokerage account. I don't keep one account. I don't like to keep all my eggs in one basket, because that's, also tricky, because on Monday morning you wake up and the broker says, so long, thanks for all the fish, and he's off with all your money. Not to say that they will, but I'm not a firm person who trades, who how can I put it, trusts every broker under the sun. It's a bit tricky. I would rather split my funds up if I can. Even if I take the same trade across a number of brokers, that's fine. But at least I know each broker's got its own thing going. And I don't leave money with brokerages. So, for example, if there's a $25,000 account, a $100,000 account, that's what it remains. And if it profits, I'll take that money out and put it in the bank rather. Not that you should trust banks, but banks are a bit more trustworthy than say, brokers. Sorry, brokers, no disrespect to you. Some of you are the most wonderful people on earth, and obviously the most trustworthy people on earth, but some of you aren't, unfortunately. So, you do have to be careful of that. So I don't sit and count how many trades I take. I don't sit and count how many trades I've got at any one time on any one particular account. But obviously the bigger accounts are managed more carefully, and those can have quite a number of trades on at any one time. And on a system like this where you're risking 1%, it's good to have 5, 6, 7, 8, 9, 10 trades on at any one time if you can. But there are times of the year when you can't do that. There are times when things are quiet, when things are not happening, and there just isn't any trades available, and you just can't find trades, But generally there's enough to go around. There's always enough trades to go around. And that's what I always tell people. There's enough to go around. Don't worry about how many trades. Just, if you need trades, go through the list and look how many. This is just a watch list, okay? Look how many Forex pairs there are, how many commodities there are, how many indexes there are, forms of crypto. I mean, I've only got 2 or 3 forms of crypto on here just for my own sake. There's another plethora of those as well. So you can go insane looking for things to trade. There are plenty. And for those of you that are into algorithms, there's even algorithms out there that'll search trades out for you if you want. So it's totally up to you on that front. But don't get caught up in how many trades, or how many trades should I take, how many trades should I have, or whatever the case. Look for the trades. Now, what you can do if you're a swing trader is if you're going to trade less, if you're the kind of swing trader who doesn't have many trades and you don't find many trades, then maybe just risk more on one trade, for example, or 1 or 2 trades, than you would risk over a case of 10 trades. That's also an aspect to look at. But just remember, you've got to keep the risk the same on every single trade. Don't change the risk, because then you start messing with yourself at the end of the day. You like metals? Yeah. The trouble with metals, don't forget, commodities are cyclical. Commodities go up and they go down. They go up and they go down. They're like a wave. They go up and down, up and down, up and down. They don't go up like an index. So metals aren't the big win at the end of the day. They're not a great investment. They're a great trade. Just like crypto is a great trade. I don't want to invest in it, but it's a great trade. You ask me, g'day, Henny, how's it going? A lot of you will ask me, why don't you invest in crypto? Well, since day one when crypto came out, I was always the firm believer that crypto is built on fresh air, that crypto is built on no asset value whatsoever, that crypto is not going to give you any kind of long-term win. And I was wrong. I was so wrong, because had I invested when it came out and had I put the money in when it came out, I would have been as wealthy as, say, Blue Mango, and I would have been sailing off into the distance with billions in the bank account rather than millions. But anyway, that's fine. That's how it goes. I'm invested in the share market. That's done well for me. That's done extremely well for me. Still does well for me. And it's long-term investments, long-term portfolios. And those portfolios have an asset value. So I know if things go pear-shaped, they still have a good asset value. Whereas if the carpet gets pulled out from crypto, you don't know where you're going to end up. You don't know if there's going to be anything left, because basically, for me, the way crypto is built is it's one trader trading against another, or one person buying from another. And the human beings that own it are creating the value of the product. This is not like a digital currency that you would get from, say, the USA or the UK or Syria or whatever, if they created a digital currency, or even a world digital currency, because that kind of digital currency would be based on an asset value. It would be based on the asset value of the countries it's involved with, or the country that it's involved with, just like the dollar is at the moment. It's based on an asset value. It's based on how the countries run, how the business run, what the value of the country actually is. Whereas Bitcoin is based on what? Crypto in general is based on what? And you'll tell me blockchain technology. I'll say, what is that exactly? And you'll try and explain it to me. At the end of the day, it's built on fresh air. Everyone will tell you that. Even the CEOs of some of these big investment companies will tell you the same thing. It's really not built on anything specific. It's built on a market. It's a market that's made up and built. So that's why I've never invested in crypto as an investment. Why do I trade it? Because I'm the type of person that will trade orange peels if they're available to trade, because they're tradable. And I know that it's in and out, and I know it's a short-term thing. I'm not putting my entire life savings into something and hoping that one day it's going to pay me back with anything in that sort of scenario. That's the same as putting all your money into a Ponzi scheme and expecting it to pay you back one day. And if you think it can't happen, if you think it can't go wrong, all you have to do is look back at all the Ponzi schemes that have occurred in the past and then think, ooh, I never thought that would be that kind of problem, and it ended up being one. So just think back on all those. I mean, one of the biggest ones recently was Bernie Madoff, and you know what happened there. And if you don't, go back and have a look. It was 2008. Go and have a look. Okay, so David, how's it? Good afternoon. Good to see you guys. And it's always nice to have you guys as company on a Thursday and a Tuesday. It's always lovely. And we get to chat a little bit, and we get to talk about the markets and get to discuss the markets. Now, there was another question from a chap who doesn't speak English very well, so hopefully I'm speaking clearly here and you can understand well, or at least you can translate it or something to that effect. But he is a member, and I did try to point it out a little bit in the members video, but I think I'll try and give it a little bit more detail here. We'll use the S&P 500 as an example for this. But he mentioned something about there's a rule on the book somewhere where you shouldn't, on a trend trade, you shouldn't get into a trade if it hasn't retracted 20% or the 10 and 15% or something to that effect. Now, I'm trying to get around the question, but what I say on a trend trade is always look at trends as follows. Don't worry about percentages. Don't worry about the 20%, 10%, 15% rules, things like that. These are just things that are written into the books just to, it's extra confusing stuff that you really don't need. You see, at the bottom, you buy, at the top, you sell. At the bottom, you buy, at the top, you sell. At the bottom, you buy, at the top, you sell. That's how a trend works. So if you've got a trend, you buy it at the bottom, you sell it at the top of the trend. The trend is depicted by, you draw a trend line in and it just needs 3 touches. 1, 2, 3, 4, 5, 6, whatever. As long as there's more than 3, then you've developed a trend. And you draw the trend in and then you're looking for the bottom, you're looking for the top. But if you're looking at that 20% scenario, at the end of the day, what you can do is if you draw lines in here. Now, I'm just going to draw a few lines in here just to depict for you how you can draw on the way up, how you're taking your trades. So I'm going to draw some straight lines in so that you get a good idea. So for example, this one's going to come back and you're going to buy it there at that level. And then the earlier purchase would have been at the next level, which would have been there. You would have bought it there. The next one would have been, you would have bought it there on that green line. You would have bought it there and so on. Okay. So these are levels that you would be buying to because it would be coming back to those levels and going up. That's basically what you're looking for. And if you don't want to do it with lines, for example, like old Shaney uses Fibonacci, you can use a Fibonacci as an example for percentage retractment. Now, Fibonacci's can be drawn from different levels. I'll normally draw it from the last start of the trend on its way up, not from the first start of the trend. So this trend would have started at this level after it came down. That's the next trend level up, and that's the level I'll take. So let's take that level there on a Fibonacci. And I don't want you guys to get confused with these indicators. I just want to show you because the client or subscriber asked, the 20% trade rule. So what they're saying is, if this pulls back into the middle here, don't take the trade there. Rather wait for the trade to come down to this 20% level before looking at taking the trade long. And if you were looking at taking the trade long, you'd wait for a green candle to come out of here and take the trade from there. Or you can wait for the 40% level down here for the green candle to go out. Or you can wait for it to get into what we call the golden zone. If it gets below this 50% between the 50 and the 60, that's what we call the golden zone. It'll normally, in all likelihood, turn around in that level, and you can look for that as well if you want to use Fibonacci as an example for that type of thing. So that's just to explain, that kind of scenario where they say, don't be taking the trend trade within the 20%. Wait for it to get to the 20%. There's no hard and fast rule, but you can look at it from that perspective, and that perspective will give you some perspective on how you can move forward with your trading if you're looking at it that way. Just look for levels. That's what you want to be doing. You want to be looking for levels. And if you're not using indicators like myself, then just use the trend lines, use the resistance, use the support. Gives you an idea where you are in the market. And it's great because now this gold trade can go two ways. And this always happens in trading. This is not something new, but this will always happen in trading where it gives you a quandary. It gives you a situation of, this could go short or long. Now, this morning I looked at this red candle coming out of the support, thought, well, if that closes below the support, we get another red candle, we're going short. It didn't. It went long. It went back into the level. This happens. But now it goes back into the level, gives you a green candle, you think, I can go long. Actually, no way, I can't because there's a resistance right there, quandary. So now you've got a resistance stopping you from going long, because if you go long here, it could get another red candle coming off of that resistance, breaking back through the support, giving you the red candle to the downside, giving you the short trade. So you end up with a quandary at that level. You can't take the trade. You need a green candle to come past that high and close, or you need a red candle to come past that low and close for you to get this trade. You're not the only one with this problem or this quandary, because otherwise this would have moved already. The millions and millions of other traders and money and liquidity in the market are thinking the same way you are, because that's why this hasn't moved anywhere yet. Everybody's not sure which way they're going. And sometimes with that, you'll get an undecided candle. Some data came out recently. How's it, Nick? That claims 67% of the volume in the stock market are retail traders. It's usually 20%. Nick, in all reality, retail traders make up 5% of the market. We don't make up that big volume. We don't make up no. The big volume is from the institutional traders. In reality, retail traders, really, we're a minuscule part of the market. We're not that big. Do you use the candlestick wicks to help with picking temporary bottoms and tops? Yes, I do. You know, the wicks are really important to me. That's why I have candles on my chart. You know, the whole point of having candles on my chart is I can see, for example, there's an undecided candle with wicks on both sides. Or, for example, yesterday there was a bit of volatility. It tells me there's a lot of buyers and sellers going both ways. Undecided, little man in the middle. That was the news, okay? But what it also tells me, when the buyers are getting back into the market, it tells me when the sellers are getting back into the market. It tells me if there's pressure to the selling side, if there's pressure to the buying side. So the wicks are really, really important. And I do use the wicks, yes, absolutely, because there's liquidity in the wicks, obviously. But there's also like a storybook behind the wick, which tells you what's happening in the market and which way it's going. So I read the wicks like a book. I read the candles a bit like a book. But I don't paste everything as on the candles. I don't go, oh, the candle's done that, so that's going to happen. Because what you must remember about any candle is it's only valid for the time frame that it's on. In other words, a 4-hour candle is only valid for the next 4 hours, as to say what might happen. But it gives you a lot of information. It gives you good information. But the reason I do a lot of my research on a line chart as well is because closing prices are more accurate. So on the higher time frame, when I go to the day time frame, for example, and I look for my resistance level and I look for my support level or my trend or whatever the case, then I will look for it on a line chart because the closing prices are solid. Those are the price, and you know exactly what that's worth. And then there will be some wicks that go past at some time in that, but I don't want to pick up the spikes when I'm looking for those levels. Then I'll come back to my 4-hour or the time frame that you're trading on, and then on those time frames you're going to look for levels that are relevant with wicks, okay? Because the wicks then become part of the book. They become part of the information that you're looking for on the trade. So yes, use the wicks. Always use the wicks. The wicks are going to help you in many, many, many ways. And you'll see here that I've drawn this line in on the wicks as well, using the wicks, but this is on the 4-hour. This is on the time frame that I'm trading on. Candles also give me my supply and demand levels that are important because I can see red candles have been pushed down here hard, which means there was a lot of selling pressure at this level. So I'm using that level as a key level because it's pushed the price down heavily at that level. Simple, really. That's basically it. Then at the bottom here, you see every time it reaches, then all the buyers come back in. Every time it reaches, all the buyers come back in. Every time it reaches, all the buyers come back in. Use the wicks in many different ways if you can. Don't just use the wicks in one specific way. There's a lot of information on the wicks. How's it, Sir Lunchalot? Good to see you again. Always good to have you on board. So yeah, no, that's true. But yeah, no, I don't know who says that 67% of the market is retail traders, because it's not. We only make up 5% of the market. The big part of the market really is made up by institutional money. We might be a large part of the market in numbers of traders, but numbers of traders as in small amounts. But when it comes to the actual money and the actual volume, that comes from the institutions, not from us. We make up numbers in people and bodies because institutions have like 1 or 2 people trading millions, where we have like millions trading 1 or 2 cents. So that might be the thing they're thinking of. Volume of people, volume of amount of traders or something like that. Yeah, that might make a difference, but it won't make a difference in the market because the actual money in the market is a small percentage from retail traders. Very small percentage. So, yeah. How's it, Tywald? Meetings over. I used to love those meetings. You know, I worked for a corporation till I was about 27 years old. And then I started working for myself. So in all those years, I learned a little bit about the corporate world. It's probably changed a lot by now, I mean, obviously. But I remember those corporate meetings and those corporate stories and, and all the rest of it. And I used to get quite bored. But yeah, like I say, that was many years ago, and I'm pretty sure corporate's changed a lot since then. Yeah. Nyan, how's it, Nyan? Good to see you as well. David, we are 1 in a million. 1 in a million is something like that, David. I think that's what it is. We are 1 in a million. No, we don't make up the volume, that's for sure. We definitely don't. We like to think we do, but we don't. We don't move the markets. Retail traders don't move the markets. The markets are moved by the money, and it always is, always has been, always will be. And the guys on the floor and stuff like that all over the world. But there are a lot of institutions around the world as well. Big time that are in the market. I guess it depends what we're trading as well. I think maybe crypto would be a different story. I haven't looked into it, but I think crypto might be a different story. Crypto might have more retail traders because the big institutions were not into the crypto at all until recently. So that might have been moved by retail. That's a completely different story, and that's crypto. But when it comes to the normal indexes, the normal Forex, the normal commodities, that sort of thing, that's definitely the other way around. But I don't know about crypto. Crypto might well be a different scenario because institutions were not big on crypto for a long time. Only recently did they start getting involved in the crypto game, start creating ETFs, and start getting involved with Bitcoin and that sort of thing and creating markets and what have you. So, yeah, that could be a completely different statistic when it comes to crypto. That's an interesting one. Should actually look into that one and see. Because that's something even I overlooked and thought, I haven't thought about. And also the interesting thing about crypto is if it's in a market or ETF or whatever, those markets are open every day, right through the weekends and whatnot, whereas the stock markets are not. They are closed. So that's quite interesting if you think about it. Always interesting, yeah. So yeah, that kind of answers those questions. The amount of trades, the 20% rule. So hopefully that helps the gentleman who asked those questions, or two different people asked those questions. As I always say, rise above the algorithm and understand that you're trading against human beings. And then suddenly the aha moment will come to you. Because what you see on a chart here is a chart. You see lines, you see spikes, you see candles, you see red, you see green, you see all the fancy things, you see numbers. And you think, well, because that breaks through that means that, and that means it's a buy, whatever the case. But what you got to start reading this as is what other people are doing and why they are doing it. Why have I drawn this in here? Why have I drawn this demand in here? Because if you look at that huge push up here, huge push of money, what that means is there was a vast push of money up here, which means people bought, pushed it all the way up there, which means there was a lot of money lying here. So I draw this here with a view to, if it comes back to this level, is there still money waiting there for some more push to the upside, some more push back? You've got to think about where the money is and what the people are doing with that money and how it's working. Yeah. So yeah, keep that in mind when you're trading. Keep that in mind. Always remember, you're not trading against lines. You're not trading against maths. You're not trading against algorithms. Trading's 50-50 because you're trading against people, because people do strange things. Well, people do strange things. We're creatures of habit. Human beings are creatures of habit. We tend to do the same thing over and over again. And that's why you've got charts. Because you look back on the historical value, you look back on the history and you say, this is what the price tends to do when the chart does that. What it means is that the human beings that did that before will probably do it again in the future, because that's what human beings do. We're creatures of habit. But not only that, all those human beings are going to do the same thing because they're doing the same thing you are. They're looking back and saying, well, this happened in the past, so in all likelihood it will probably happen again in the future. And they're thinking exactly the same way you are and doing the same thing you're doing, which is why you end up with trading as it is. What is trading at the end of the day? It's all in the word, isn't it? What is trading? It's trading. It's between two people. You're buying and selling something. It's not about buying something off a line. It's not about buying something at a price because it broke a line. It's not about looking at a chart and saying, the algorithm's doing that, so it must be going to do that. No, it's about buying and selling. So when somebody says, I want to sell my UK 100 share at 92.33, then he wants to sell it at that price. That's what it's about. He wants to sell it at that price. My little man's falling over again. I'm just putting him back. Otherwise, it'll just be a night. I don't like my little man lying flat on his face. Just feels like he died. Anyway, little green man. Where's my mouse gone? There we go. Right. So if you look at this, you're looking at this and thinking, oh no, that's a bunch of candles that have broken through there, so I'm going to buy it. No, that's a bunch of human beings that are advertising that they now want to either sell or buy their gold or their UK 100 at that price, 92.34. They got a big for sale sign outside saying we're selling here, and then you come along and you want to buy it if they're selling, or you want to sell yours to someone who's buying. That's as simple as get. If you walk into a trade store and you walk into a shop and you start negotiating for a discount or you start negotiating for a price, that's trading. You're buying and selling. You're buying from the guy at the shop, or they're buying from the guy that's trading it to you, whatever it might be, and he wants to sell it because he feels it's a good time to sell. Maybe you're buying a car or something like that. That's trading. You're trading a price. You're working out a price for something. Trading is exactly the same. When you put a stop loss in place and you say, everyone's hunting out my stop loss. Oh, they're watching me. They're hunting out my stop loss. No, you put your stop loss out there, big for sale sign. I want to sell my share at 9070. I want to sell it at that price. That's the price I'm selling it at. Here's a big for sale sign. That's all. And I come along and say, oh, that looks good. I want to buy it at that price, so I'm going to pay that price for it, and I take your stop loss and I pay for it. But you advertised it at that price, so I pay for it at that price. I'm not searching out your stop loss. I'm searching for a good deal, and I pay for it at that price. But the nice thing about trading, though, here's the nice thing about trading, is I can't skip all the other prices and just jump to your price. If I want to buy, I have to swallow up all the prices in front of it before I can get to your price, which means I have to spend a lot of money to get down to your price. So the further away you put it, the more chance you got of keeping it. So if you put it in a good invalidation area, like I always say, then there's a good chance you'll keep your trade. But if you take your trade and you move it into an area where people are going to buy it, then they're going to buy it, and then you're going to sell your stock. It's the same as if you put a take profit in. So a lot of people say, oh no, don't put your stop loss out there. Don't put your take profit out there because people are going to hunt it out. Yeah, you're advertising it. You're putting it out there. And if you don't put it out there, it might just go flying straight through it, and then you won't have anything to stand on, will you? A lot of people say, but institutional traders don't use stop loss. And you know what? They're actually correct. They don't. They don't use stop loss. Why do you think they don't use stop loss? And it's simple, really. Why don't institutional traders use stop loss? People trading with millions and billions of dollars. Because if they had a stop loss and the price came through that stop loss, there wouldn't be enough money or enough trade at that stop loss to take them out of the trade. It would just keep on taking more and more and more and more and more as it goes down, and it would probably go down to quite a low level because they've got such a big trade. So big trading companies like that cannot have a fixed stop loss. What they have to do is decide, look, we need to get out of this trade, so we're going to look for liquidity and we're going to start working our way out of this trade, and that's how they control their stop loss in comparison to you with your 50-cent trade, which will get taken out in one little flash. You know, that's completely different. That's not the same thing, guys. That's not the same thing at all. So don't try and compare yourself to these big money traders because you're not the same. You can't be. They're working on a different process. Hi, Mario. Good to see you. Charam, greetings from Italy. It's sunny here, and we go to the sea. You must enjoy it. It's sunny here as well. It's a beautiful day here in Cape Town. And yeah, it's a good day to go to the sea. Only thing is our sea is pretty cold, but it is nice. It is nice. David, I appreciate your approach. I've been trading the S&P for 15 years. I trade almost exclusively the 15-minute chart using the E-mini futures. That's great, David. That's fine. And if it works for you, always good. And I always say, don't change what works for you, because if it's working for you, you stay with it. That's perfect. But like in the old days, I did trade on 15 minutes. I trade on 5 minutes. And when you trade on the 5-minute, 15-minute, that type of thing, you don't want to be trading too many instruments, obviously. You want to cut it down to 1, 2, 3, maybe 4. I used to trade 4 or 5 when I was trading on 5 minutes and keep that for that. And then the investments were a totally different thing. But swing trading, I'll put everything on because, just always looking for trades. But on the lower time frames, on the 15-minute and that's perfect. That's great. I just, a lot of the traders that have been in the market for a longer period of time, older ones, normally end up on swing trading because we like to take a break, go down the sea, relax, whatever, not sit watching charts all day. And but we do need to keep ourselves busy as well, because the biggest problem with traders is we get bored. And when we get bored, what do? We start dropping down the time frames and we start trading on 5-minute charts because we're bored. And that's where things go kind of pear-shaped sometimes. So that's one of the issues. And then the other issue, what do we do when we start getting bored? We start making YouTube videos, or we start doing whatever other strange things that come to mind. There was a time when I was even like keeping myself busy, maybe playing games and stuff like that, because charts are just running in the background, and if you haven't got something else to do on the day, it can be quite boring. Trading can become quite boring, insanely enough. But when things are boring, then things are good, because you're probably doing the right thing, and you're probably making money, and you're not stressing or excited about anything or worried about anything. Depends on the liquidity when it comes to stop targeting, less volatile. As I say, nobody's targeting your stops. You've put a for sale sign out. It's for sale. That's it. End of story. No, and obviously that's what they're looking for. Everyone's always looking for liquidity. Even you, when you're trading, what's your basis of trading? Your basis of trading is to look for liquidity. You need to find liquidity in the market when you're buying a trade. So when you're looking for a trade, you're not trying to trade based on just direction. Sometimes you're looking for the liquidity in the market. So at a support, every time it hits that level, it goes up, which means there's liquidity there, there's money here. So if you're trading, you're looking for that liquidity. You're looking to buy the share there and go up, because that for you looks like a good price, because everybody else buys there. And everyone's looking for liquidity, whether you've got $100 billion or whether you've got $1, you're looking for liquidity to buy your stock. You don't want to buy it in an area where there's no liquidity. You want to buy it in an area where there is liquidity, which is why I always say also buy liquid products. Don't buy products that don't have liquidity, because when you want to sell it, that's when the problem starts to evolve, it starts to come in. When you can't sell your shares or your indexes or your commodities or whatever it is you're trading, because there's nobody there to buy them. That's just horrific. Worst case scenario, which is why I never touch penny stocks. Total waste of time. A less volatile instrument will be easy to get the stop target for those bargain hunters. No, you see, the thing is, Nine, a less volatile instrument might be less liquid, and there might not be enough liquid there for those people to buy, so they might not be interested in it in the first place. So that also, RC's 1% rule, and I'm limited to 15 point based on my 75k ongoing trading. Your stops seem much further away. David, the way I work my stops, and I showed it in my other video where I still have the other trades in, but the way I work my stops, if I wanted to take a long trade on this particular trade right here, right now, this trade here, let's say I wanted to take a long trade here, what I do is, the first thing I do is I go and look at this trade and say, where do I want my stop loss? I want my stop loss in an area of invalidation, an area where I know that if I advertise the price of the stop, they're going to go through a hell of a lot to get there and take my stop out. And also, if the price gets there, the trade's invalid, it's completely worthless. I don't want to be in that trade anymore. I wouldn't want to be long there. I'm totally on the wrong side of the trade. Let it go. That way, it prevents me from psychologically making the mistake of trying to move my stop loss or dollar cost average or do anything stupid like that. I realize that my trade is completely invalid. It makes it better for you psychology and with the fear and that sort of thing. So you understand that you're going to take that loss. Once I've chosen the area of loss, then I simply work out the size of my trade. And I work out on the 1% what the size of my trade is back to the the price. So, for example, if I decide to put my stop loss at 137, then obviously I'm going to go in here. I'm going to say, okay, my stop loss is 137. That will make 0.4 lots will give me a $243 stop loss, which is pretty close to 1% of a $25,000 account. And that would be my stop loss. So my stop loss would be at 137. It's completely invalid area. I'm going to be buying at that level and with a take profit up there. So I've got a good risk to reward. I mean, I can put that in here. Let's say I want my take profit at 138.847, or there's 138.869. It's telling me that I'm getting a $300 profit for a $243 loss. Close enough. That would be a fair risk to reward. It's okay. It's fine. And that's how I work out my trade. So I don't first say, oh, no, I'm going to take 4 contracts and that, and then work out my stop loss. No, I don't do that. I first work out where's the stop loss, and then I work out the size of the trade, and then I work out where I'm going with the risk to reward. That's as easy as it gets. That's the strategy. That's the business plan. And always try and make more on your wins than you're losing on your losses. And then at the end of the day, you will somehow have a profit. Okay. Yes, because anything further away might give you less than one contract. You see, you're not working on, I don't care what size the contracts are. I don't care if it's 0.5, 0.4. For example, this would be a 0.4 lot, okay, on this particular account. I don't care what size the trade is. I just care that the size of the trade works according to the size of my stop loss. That's all that matters. Whatever size stop loss you choose. And some people work on 2%, some people work on 1%, some people work on 5%, 6%, 10%, some people work on 0.5%. Depends on your threshold and what you want to work on in each individual account and how you want to work it. And it also depends on the size of your account. I mean, I have a $100,000 cash account lying on the side there that I use on a frequent basis. That's one of my better accounts. And that one makes me a lot of money, but I trade a lot more money on it. So, yeah, it's just a different ball game. Whereas funded accounts, you want to be a bit more careful with. Those are different, and those you want to keep them alive. Just depends on your risk threshold on every individual account. But work out the risk first. Work out your stop loss first, and then work out the risk back, or the amount of loss you can take back to the cost. You don't have to take one contract. You can take half a contract. You can take 0.4. Why do you have to take a whole contract? Not always necessary, unless, of course, you're trading with a broker that only allows maxi contracts, which is unusual because most brokers allow mini or broken up contracts or mini contracts. So you shouldn't have a problem with that in any way, shape, or form. It's about the money, not about the size of the contract at all. It's about the money. It's about the amount of money that you can make on the contract. That's as simple as it gets. Since I started the YouTube channel Blue Mango, I actually haven't indulged in it at all. I haven't even gone back, and I did do that. I actually got involved with that sort of stuff, but it was just fun on the side, and sit there with the charts and then playing on the side. But no, I stopped that. I actually just let it go, and I stopped doing that. And actually, since I took up the time by making some YouTube videos and stuff like that, I've put that aside, and I find more time for this, and it actually works out a little bit better, and it's probably better for my brain. Sometimes I have to go to micros with the index futures to get better money management. Yeah, Nick, that's the thing. You sometimes have to go to the micros to get better money management. It's totally, it's irrelevant. You don't have to take big contracts. It's not necessary. Look, I'll tell you a story, and that is, it's insane actually. But with the US 500, the S&P 500, when Donald Trump was in charge the last time, we got sucked into a very similar scenario that we're in now, where we were buying. You couldn't go wrong. You just kept on buying. And even with my 300 million years experience, I got sucked into the same old profile of, I can just buy every time the market pulls back a bit. We'll just buy every time the market pulls back a bit. And just like any trades, on a larger account, I started on 1 contract, then 5 contracts, and then it was 10 contracts, and then I made it 20 contracts. And at the end of the day, when the market was up at 4,000 something, or I can't even remember the exact figure, but it was at the top, it was quite high. and I had like 300 contracts running. Think about that, 300 contracts. And then you're thinking, this is going to make millions. This is just going to go insane. And then it starts dropping, okay? And 300 contracts is really, really expensive in rands. It's about 300,000 per point. And it just starts dropping, okay? And you think, it'll be fine because I've been doing this for a couple of years and it's been going up. And you drop a couple of million without even thinking, but that's in rands, okay? So in dollars, couple of 100,000, whatever. Still a major profit, still a huge profit. Don't even worry about it. Major profit. But the loss off the top becomes huge because you become so confident over time of just building the account. And you started with 1 contract, 10 contracts, 20 contracts. When you get to a point where you're sitting with 300 contracts and you're not even realizing how big your account is, that's when you have to concern yourself with how much you can lose overnight with a big drop. So watch yourself. Don't overextend yourself and don't become overconfident. It can cost you a lot of money off the top. You can still walk away profitable, as in my case I did, but that much more could have been in the bank if you hadn't have become that overconfident with that kind of scenario. So that's something you get sucked into, and that's why I said to you guys the other day, this is concerning me because I've been there before, where you just get sucked in, and what you end up doing is you keep on making the trade bigger and bigger and bigger. And I can see it happening with a lot of new traders that haven't seen this before, because nothing can go wrong. It just keeps on going up, so you can just keep on buying, and every time it goes down, it just goes up again, and it just gets that overconfidence going. And then what normally happens in a scenario like that is when everybody's in and everybody's overconfident and everybody's got huge sums of money invested, this doesn't drop 50 points, it doesn't drop 100 points, it drops 2,000 points. For example, it'll drop from 6,650 to something like 4,500, and everybody will be going, what happened? So that's what you got to watch out for. That's what you got to keep your eyes on. Yeah, I just thought I'd tell that story, but it didn't hurt me, but by the same token, it made me think, like, what are you doing? Getting sucked into this, and just, you keep making it bigger and bigger and bigger and bigger and bigger and bigger, and it's on leverage trading, so it's huge sums of money. Great British Pound US dollar, Great British Pound US dollar. Let's go and have a look at that Great British Pound US dollar. This is the Euro, Great British Pound US dollar. Boom. What have I got on the Great British Pound US dollar? Okay. What we've got here on the Great British Pound US dollar, look at all the sellers that came back in there. So that's a prime example of using those little extensions. Is there you've got your sellers all coming back in, the spikes, absolutely wonderful. But what's happened here is it's broken through a little resistance here. It's gone up, gone all the way up. The sellers will come back in. But what it's actually doing as well is come back to retest. And all the buyers got back in, but the sellers are coming back in again. So what we need here is a strong green candle giving us the upside, or the red candle to break through this level and say that's not a level anymore. Give us the red candle to the downside, giving us the bearish trade. Now, Sir Lancelot is asking if it's a good short. Now, the best way to check that, Sir Lancelot, is to use my normal method of check. And that is just take this, get the trend line up, the good old trend line tool, one of our favorites, take it from the bottom here and just say, what does my trend line look like? Okay. So now you've got your trend line in, and that's actually quite good. So now you've got your point touching there, 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 and a red candle breaking through that. Lovely confluence here, and it's coming down to the resistance. If it doesn't give a green candle, it breaks through the red here. We've got a clear cut short, and it does look like it will probably, in all likelihood, break to the downside here, giving you the short trade. And if it breaks back into this level, that's fantastic. That's a nice one. So keep that in mind. But there is something that I'm seeing on this chart that you need to watch out for before you take the trade. And that's why I say wait for it to break past this prior low. Wait for it to go past that low. And here's the reason. Little blocky here. This is a demand of money. Now, I know you don't like to play into these, but that's a demand of money, which means it's sitting in that demand of money. There is money there which pushed this price up. It could take that money and go back up again. So wait for it before you short. Wait for it to go through that level. Give you a red candle down below there, and then short to the downside. Looks like a nice trade if it does do that. If it gives a green candle to the upside, a little bit more complicated, but if it gives the green candle to the upside, it could go up again. But I'm looking at there's more pressure to the downside, because if I look at these tails, all the sellers came back in, all the sellers came back in. There's a strong force of sellers coming back into the market, taking profit. It's human beings that are taking profit. The price gets all the way back up there, and they all take profit. They all sell, they all get out, they all take the profit, and it comes back, flying back down again. There's a lot of pressure to the downside. So let's see if it can break through that money. If it breaks through that money, good stuff, good trade, looks good. Okay. Money management approach strategy is spot on. The true holy grail are far more important than entries and exits based on charting. Breath of fresh air online. Thank you, David. That's nice to get compliments. I love the compliments, by the way. You guys are welcome to make a million comments with compliments. I love them. I love compliments. Compliments are good. But thank you. I appreciate it. But yes, as I said, Sir Lancelot, that's my feeling on this. And then, of course, now, how do you work the stop loss for this? Because you've got that huge spike. The spike's a monster, isn't it? And you want to be putting the stop loss behind that, but you don't have to. You can bring it down a bit lower if you want to, and just look at what your levels are like. So, I mean, I would put the stop loss behind that. What is now trend, was trend support, is now resistance. I'd put it just beyond that, out of the way. Don't worry about the spike. Just put it beyond there. It'll be fine. Okay. So there we go. I think I'll keep that page on, because it might just become a fine trade. I just want to see what it does. It'll be interesting to see what it actually does. It'll be nice. It'll be actually good. Now, the most important thing, that David said to me a little bit about your risk management strategy. The whole point here is to separate the charts from your strategy. And the charts are there so that you can take the trades like we're doing. We're looking at the charts. We're looking at the technical analysis, and we're analyzing the charts, and we're deciding whether we're going to take a trade or not. There's no difference between doing that and deciding whether you're going to take this trade or not fundamentally. If you're doing it on fundamentals, you'll be working through all the processes and saying, why would I prefer to go short than long on this trade? And you'll discuss it with yourself or your colleagues or whatever the case, and then you'll decide to take the short. So whether you do it fundamentally or whether you do it on charts, same thing. So you're working a process that gives your fear, your mind, your psychology the confidence to say, I'm actually going to go short on this trade. But that's not the trade. What the trade is, all of it comes in on how you manage it. The most important part of the trade is not getting into the trade. Getting into the trade is, that's what you do to get into the trade. Now you've chosen the trade. Now you're in the trade. That's it, we've got a trade. Now the important part comes. Now you have to manage the trade. That's the important part, managing the trade and managing the risk. The most important part of the strategy is managing the risk. And if you keep the risk the same and you manage the risk, then everything else will fall into place, and you'll manage the profits, and you'll manage the rest of the trade, and you'll move your stop losses around and your trading stops and whatever else you need to do to keep the trade going. Everybody, the mistake that traders make, and this is what I see in the market a lot, the mistake that traders make, the biggest mistake that traders make, is they get involved in trading because somebody told them they can turn a small amount of money into a big amount of money, and then they go on a course, and on that course they teach you to trust the charts. They teach you that trading is all about charts. They teach you that win rates are going to make you money. They teach you that you need a chart to make money with, and you need a system to make money with, that you need to get this right, and you need to make more wins than losses. It would be great if you could, but generally you can't. And that's one of the biggest mistakes we make. We hone in on the charts, we get stuck in on the charts, and we forget about everything else. Before there was charts, people were just trading based on fundamentals only. Do you know that my investments where I buy shares and I set and forget, as I call it. So I want to go and buy, say, Amazon or Coca-Cola or Nvidia or whatever. I don't sit and look at a chart on that. I'm not interested. I don't even have charts on my investment portfolio. They don't even supply me with charts for that. If I wanted to look, I'd have to go and look elsewhere. All I do is I look at the company for what it is, fundamentally. And I think, that looks like a good company to invest in, and I invest in it. And I keep on investing in it, and I keep putting more in every month if I can in different ones or whatever the case, because at my age, you end up with quite a few. And that's how I look at that kind of investment. So then you realize that charts are not important. But when you're trading, it's a great way to pick your trades. It's a great way to work out your strategy. It's a great way to work out when to buy, when to sell, how to sell. And we all hope that we're going to win more than we lose. We all hope that, but that doesn't happen. But we all would like that to happen. And we all want to feel confident when we take the trade. We don't want to take this trade with the knowledge that we're going to lose it. We want to take this trade with the knowledge that there's a good chance that we're going to win that trade, and we're going to show everyone how good we are at trading. That's what we want. That's what we actually want at the end of the day, and that's what the charts are for. But that's not the important part of your trading. And that's what we get sucked into. And a lot of these people that teach you this, and I will say you can gain a lot of information from absolutely every old trader, other traders in the market, no matter who they are. It's up to you whether you absorb that information or not, or whether it's worth anything to your system or not. Totally up to you. And nobody out there is giving you bad information. Most of it is decent. But take that information and use it to your benefit. But most of them won't tell you that it's not about that. Most of them won't tell you that you've got to have that business plan and work it out properly on the other side. That's the unfortunate thing. It's really important that you understand that you need a plan. You need to manage it, and you need to manage the trade. And that's the important part of the trade, is managing the trade. You could take these trades with absolutely no lines on them. You could take these trades with actually no charts. You could just look here and say, I'll take a trade. And as long as you manage it, you'll be fine. Charts are nice for managing the trades as well, though, because you can draw the lines in, you can see where the price is, and it actually works out well for you. And as I say, I like my charts because I read them like a book. I see human beings behind these charts, and I'm looking at what they might be doing or might not be doing, and where the price is, where the money is, where the liquidity is. So without the charts, I'd be kind of lost. It's important to have the charts. But I don't believe that the charts are going to predict anything for me or make me the money. I just use them to read the book. That's all. Shane, good, there you are. We've been waiting for you, dude. All of us are waiting for you. In fact, everybody here was saying, where's Shane? Good to see you, Shane. Welcome back. Hope you got some ads. You always get the ads, remember. The spike was the Brits thinking that Powell was going to cut 4.5% instead of 0.25%. Wow, that's quite insane. Expecting 0.5% instead of 0.25. They're not greedy at all, are they? No, not greedy at all. How many trades you take on your account? Sometimes I have 3-4 running. Feels sometimes too much. So lunch and lot, if you have 20 trades running at the same time, that's fine. You can have as many trades on your account that you want. The more the better. On a swing trade, the more the better. If you're trading 5 minutes or 15 minutes, be careful, because you're going to get yourself into a knot. But if you're trading on 4 hour and day and weekly and that sort of thing, please, by all means, trade as many as you want to. As many trades as you want to. No problem at all. Actually, the more you got, the better chance you have. You must remember, you're going to take 10 trades. You're going to take 10 trades, and it might be over time. And on those 10 trades, you're going to win 5, you're going to lose 5, and you want to make more than the 5 that you win, okay? If you take them all at once, or if you take them over the period of the month, it doesn't really matter. You know, it's just a question of you position the trade, you positioned it, you've put it in there, and it's fine. So don't worry about how many trades, and don't limit to yourself to the number of trades. I keep getting that question as well. How many trades should I take? No, do not limit yourself to the number of trades that you can take. You can take as many trades as you want to, or as little trades as you want to, depending on, you know, how you feel and how comfortable you are with it. Don't limit yourself, because then you're going to say, "Oh, I should have taken 10 trades and I only took 5, so now I'm going to force another 5 trades in." Don't do that. Just take what's available. If the trade looks good, take it. If it doesn't look good, don't take it. That's as simple as it gets, really. Don't overstress yourself on how many trades. That's not important. I'm curious about whether you use any volume calculations when weighting your support and resistance levels. I don't bother with the volume anymore, because you know what volume tells you, David? Volume tells you this is a valid move or this is not a valid move, okay? So in other words, you get a long candle and you get like small volume, then it's not really a valid move. Or you get a long candle, you get lots of volume, or you get a small candle with lots of volume, then it's a good move, it's a strong move. That's all it can really tell you. Volume weighted average price, that's not going to work on higher time frames. It works on the lower time frames more. You can get a lot from lower time frames, but it's just another indicator that you don't need. There's so many indicators that you can use that you don't need. If you want to use the best indicator on earth, the only indicator, the indicator that all the institutional traders use, all the pros will use it, and sometimes it's the only indicator that they'll use, nothing else. Use the RSI, the Relative Strength Index. That's the only one that actually works. And if you want to know more about it, just watch, I think it's 2 videos ago, I did a whole video on RSI, on how you can use it perfectly. That's the one indicator that I will go back to and just say, just have a look and see what it's doing, to see if it can confirm my trade if I'm a little bit stuck and I'm not sure which way it's going to go. I used it just the other day on the S&P just to see what it's doing and where it's going and what's happening. The RSI is a perfect one. Shane likes to use Fibonacci. Fibonacci is also very good, but that fits in really well with support and resistance anyway, so that's great. A lot of institutional traders will still put volume on your charts and whatnot, but you see what I found myself doing about 15 years ago, 20 years ago, is having a chart with a whole number of things on it. I had the volume, always had the volume, at the RSI, and then I'd add the stochastic and the MACD. You got all these things on your chart, and your chart becomes this small, you know, like a little chart, a tiny little chart. And then if you want to have a situation where you've got a bunch of charts like this, you can't even see the charts, for example, you're not even sure where the price is if you're watching a number of prices on a watch list, and then you just start confusing yourself with all the indicators you've got, because what also happens is you start having a situation where the indicators are actually working against each other, which means you working against yourself, because you say, oh, I want to buy that. Oh, wait a minute. That indicator said I should sell it. Oh, that one says I should buy it. And you're totally confused. Also, what happens is you end up with a mishmash of lines on your chart. You can't even see what you're doing. What I've seen traders with line after line after line after line after, and I'm looking at the chart thinking, where are you trading? What are you trading? What are you trading? It's so confusing. So be careful of adding too many indicators. Be careful of going overboard with the indicators. That's crazy. Try and back off from all of that. You know what the problem is? You get into this never-ending cycle of doom. I call it the never-ending cycle of doom. And that is, I got a system, I'm trading with it, and it starts failing 2 or 3 trades. Now remember, every time you fail in trading, it's not the system that's failing, it's you. You're the one, because it's all in the head, it's all psychology, it's all about fear, and it's all about how you trade in and out of your trades. Because you could trade without any system at all, and you would still have the same problem. So, what happens is you take a system, you look at the system, you trade with the system works for a few trades and starts failing. So what do? You go out there, you look for the next shiny tool, you look for the next system, you find something, up comes VWAP, and you start trading with VWAP. And it works for 2 trades, and this is great, this is the system out of heaven, and then it starts losing again. So what do? You go to the next system, you find Bollinger Bands, that looks good, trade with that, and it works for a few trades, and that's great, and then it fails. But the thing is, what you've done is you've left your first system on, you've left the VWAP on, and you've also left the Bollinger Bands on, and then you go and find the next system, Ichimoku, for example, and you put that on, Now you've got that on as well, and you're trading with that, trading with that, trading with that. You've left all those systems on, and you've got this on. There's just a mishmash of lines. And you know what? You end up back on the system you started on. It's called the never-ending cycle of doom. You go round and round and round, looking for new systems. So many years ago, I realized I was doing this as well, and I just cleaned the charts off. And I realized at the end of the day, I also realized I had that aha moment. Wait, this is ridiculous. When I started trading, I used to draw lines with pens and pencils. There wasn't even a computer. I dreamed of having a computer. In fact, a mobile phone with like a touch screen on it was just in my head. I never thought it would ever come to fruition. And I thought, if I could do that when I started trading at the age of 27, then why can't I do that now on a computer? Why can't I trade the same way I traded when I started? Why am I doing all this complicated rubbish? Why am I getting involved in all this stuff? And it's because someone told me that they invented this amazing system that when the moon moves to the left 5 degrees, you should trade, or something to that effect. And that's why I got all involved in it. That's why you get all involved in it, because of that. So I went back to basics, let's say. I went back to scratch. I went back to basics. And that's why we are where we are today. Without all this stuff on the charts, without all this mess on the charts. Yes, there's a few lines and a few blockies, because it helps you picture the chart. It helps you see which way it's going, whether it's going up or down. The red and green lines, or the candles, they tell you where it's going up and down. You can see the buyers and sellers coming in. So we've got some really nice technology these days that we obviously didn't have back in the old days. The ability to just flick a line in here, amazing, absolutely amazing. But all I say is, don't get caught in the never-ending cycle of doom looking for the next shiny tool, because they're out there. There's so many of them. There's so many systems. Look at all the indicators that are available. Look at that, look at that. And I don't think this one's even got all the indicators on it. This one's just got a few. There's my MT5. I don't even know where to start. There's so many indicators on there, and then there's more that you can go and buy. So no. Indicators, just go back to basics and just stop with the shiny tools and just start keeping it simple. Just go back to basics and keep it simple, and then you'll be better off. There might be one or two indicators in your life that you like to go back on and just quickly check something with, but be aware that you don't want to confuse yourself too much. Most of the indicators on the market I have dealt with, I have worked with. Most of the systems on the market I have dealt with, I have worked with, and I've used. And they haven't made much difference, to be fair. So, if you just use the simplicity, you're going to obtain the same result, because at the end of the day, the charts don't predict the future. The charts don't make you the money, and neither do the indicators. All they do is they give you the confidence to take the trade. That's all they do. It's all about managing the trade with a strategy. If you manage a trade with a strategy, that's where the money actually is. Boom, 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 boom. Okay. Boom, boom, boom. Took a day off from trading. You took a day off from trading? Holy mackerel, Shane. I'm going for day trading, and they're taking two, maybe. Yeah, sometimes I see many good trades. Even a 50% win rate system has a 95% chance of losing 5 in a row during 100 trades. Indeed, the ego hates simplicity. We are addicted to the struggle of complexity. Clarity is found in simplicity. Many thanks for the reminder. So there you go. Yeah, that's clearly it, and that's actually well put, David. The ego hates simplicity. We're addicted to the struggle of complexity, and that's really well said. I think that is the mindset of a human being. We're addicted to all the complicated things. I mean, I had so many monitors all over my wall, and nowadays my desk is a mess with 3 monitors on it, and that's it. And even that, I shouldn't be trading with that. You don't need that. I mean, you can actually sit with a laptop or a mobile phone and do your work, but I like to have the monitor, and I like to see things in bigger picture. But, we like to be complex. We like to have 200 screens on the wall. We like to have 1 million lines on each screen, and we like to have all these different things going on. We don't need that. We just don't need it. We don't need it at all. You know, it's not imperative to the trade. We tend to lose focus. We tend to lose the idea that you're in the trading game to make money. So what it does is it takes your mind and it sways it in the direction of fancy, shiny things and numbers and candles and little lines and indicators and stuff. And it takes your mind away from what you're supposed to be concentrating on, which is making money, making a profit. You know, some people sometimes say to me, "But Rob, why are you doing that and making money there? And why are you doing that and making money there?" And because I'm a trader. I'm a trader by heart. You know what traders do? We make money. That's what we do. That's what our job is. Our job is to make money. So anyone who thinks it's something else, it is fun and it's addictive. And obviously, I mean, that's why we're here. We like doing what we do. But it's about making money at the end of the day. It's not about fancy stuff at all. You know, we like to look at fancy stuff, but that's not what trading is about. People get sucked in, I tell you, get sucked into all that. You know, interesting what Nick said here. Even with a 50% win rate system, traders have a 95% chance of losing 5 in a row. What you said there, Nick, is actually very true. And interestingly enough, which is why, you know, there was a lot of guys out there touting that you can turn $1,000 into $1 million, because theoretically it's actually possible. I've done the theory on it. It is possible. If you win 10 or 11 trades in a row and you put the right amounts in and you double up accordingly, then you will turn $1,000 into $1 million on leverage trading, on the right leverage. Okay. I'm not going to go into the maths, but you can work it out for yourself. It's theoretically possible. Trouble is, some of the best traders in the world have tried it. Some of the very best have tried it. And the downside to that theory is that every single trade you take in those 10 trades, you have to effectively double up. Yeah, you have to effectively make the trade double to make it. I mean, you get to a point where you're at $500,000 and then you double it and you make $1 million, right? So that's the point. Okay, so you're going to have to risk it all on every trade. And that's where the downside comes in, because normally, even when the best traders get to about trade number 6, even if they've done really well, 6 or 7, poof, it fails and it takes it all and they start again. So it always fails. And I don't think anyone's actually achieved it. I really don't. I haven't heard of anyone who's actually truthfully achieved it. There's been a few challenges where people have tried it, but yeah, it's 10 trades in a row, full leverage, full risk, and it's theoretically possible. And anyone who wants to try it, go for it. But good luck to you. I don't think anyone's achieved it. I don't think anyone's managed to make that challenge work. There's always that one. There's always that one that's going to nail you. It's interesting, but you know, it gets to a point where it's big money, and that might have some effect on it. It might have some effect on the psychology. I don't know. And the other big thing about that is this is not scalping. You see, that's where it falls short as well. It's because people think, well, I normally win 10 trades in a row. Yeah, if you're scalping. But when it comes to that kind of trading, then you need a trade like this, okay? Then you need a trade like this one here, where you put your stop loss in place and you're putting your take profit in place. I presume on those trades, no stop loss. But what you do is you put your take profit in place. So you need a take profit up. It has to reach that take profit for it to work. You can't have you're risking it all and then take profit early. You can't do that. You need to take the full profit for that to be working, so you can take the next trade and move on and move on. And that's where the difficulty comes in, because how many of your trades, percentage-wise, actually reach full profit? See, that's the question. Because I know that in my trading, like I've told you guys before, like a couple of trades in a year will make me an insane profit. They'll go way beyond the target and they'll make an insane profit. And then there'll be a percentage of those trades which will make target, which will be great because it's more than your losses. And then 60% of my trades, which is more than 50%, will be small losses and small wins. The small wins being the ones the stop losses were taken out with trailing stops, which still made a profit, but they weren't the full profit. And a whole bunch of losses, which are either 1% or less, because I do sometimes get out of trades early if they're losing. So, you know, like for example, if I sold this South African Rand at $150 loss instead of $250, that would be considered part of that pile of small losses and whatnot. And if you look at that, then you're not going to win 10 trades in a row. It's just because it's really, really difficult. And that's the one thing that maybe you guys have figured out by now, that on swing trading, it is difficult to reach these targets. It's not easy to reach these targets. You sit with trades and you're trying to reach these targets. So that's why, one of the reasons why I take the stop loss when it's in a profit and I move it to cost and I move it into profit. And then if it comes back and takes it out, I take that small profit, which a lot of you would have taken right in the beginning anyway. It takes that small profit and that gets put into the pile of small profits. It's okay. It didn't lose. It's a small profit. There'll be those ones that reach target, which are fantastic. And you get the money and it takes it and off you go. And then there'll be those ones that kept on going north and the trailing stop just kept on following it up. And those are the big ones that make you money. So it is well possible to complete that challenge. I doubt anyone will. Sure. If only in marketing. Okay, marketing. Is it possible to make at least $1,000 a month with such small amounts that you're trading? Understand one thing about trading that's very important, and that is you need a large amount of capital to make money in the markets. With $25,000, you can. It's not that easy, but you can. With $100,000, then it's possible, much more possible. You see, my main accounts are $100,000 accounts, right? And then each risk is $1,000. And then normally you make $2,000 on one trade. Those accounts can make $10,000, $20,000 easily. But these $250 ones take a bit more time to make a profit, a bit more difficult. And yeah, but you can, yeah. But you need capital to make money, you really do. I think John Patana said perfection is when you can't take anything else away. Yeah, that's absolutely true. Perfection is when you can't take anything else away, yeah. Yeah, it sometimes takes a long time to get to the take profit, so you know it's not always easy. Now the big problem you got, for example, someone asked, now can you make $1,000 with these small things? So like this one trade could make you $700, right? But then the next two trades could lose you $500. So you really struggle to get up to that $1,000. So what I normally do is I don't work on a monthly profit. I work on an annual profit. So if you're going to work out how much can I make in trading and can I make money and can I survive and so on, always have a plan B, always make sure you got some cash. Disclaimer, most of my income comes from the investments. Trading makes money, investments make more. And like I said to you, most of the profit generally in a year comes from one or two trades that make a big win in that year, and then a number of trades that make target, which is bigger wins than losses, and then the rest are small wins and losses on the side, which basically even themselves out. So most of it comes from a very few trades. And those very few trades that make you that big money are not going to come every week. They're not going to come every month. They're not going to come all the time. They're going to come here and there. So that's why I prefer to look at an annual basis, because on an annual basis, I'm not under pressure. Because when you start putting yourself under pressure, serious pressure, I need to make $1,000 every month. I need to make $2,000 every month. I need to make $5,000 every month. A month goes by very quickly. So does a year, but a month really quickly. And if you haven't made it, then you start forcing it. You start desperately trying to make it because you need it. This is a big issue with traders. Some traders are working on a daily basis. Some traders working on a weekly basis. It becomes psychologically destroying, and it's going to affect your trading in a very negative manner if you're working on that basis. You need to have decent capital if you're going to be a trader, and you need to have a scenario where you have a plan B if you don't make the money. That is really, really important. You know what a lot of day traders do is they assume that they're going to come in, they're going to work for 2 hours a day, they're going to go in at the start of trading, they're going to work for 2 hours, they're going to make $200, and then they're going to go to the beach. And then that's the assumption. The assumption is, and the assumption is that I'm going to make $200 a day. And that's the arrogance of it, because now you walk in and I'm going to make my $200 and then you lose $400. Suddenly your plan is changed. Suddenly this is, wait a minute, I was supposed to make $200 and I lost $400. Well, that's not good. But now you're 2 hours in. You said you're going to work for 2 hours and then go down the beach, but now you've worked for 2 hours, but you've lost $400 and you were supposed to make $200, which effectively means you need to make $600. So now you're going to try and force it. Now you're going to try and stay the day and try and make the other money, and then you end up at the end of the day being $800 down. Bad day. But now you've just destroyed the whole week, because you were supposed to make $200 a day, but you're $800 down. And it just think about this, guys. It's a mishmash of nightmare, okay? You don't want to be going there. You don't want to be doing that at all. You know, if you did want to do the 2 hours a day thing and trading 5-minute charts or something, then you should just not even have a proper target. Just say, I'm going to trade for 2 hours a day and that's it, and see how we go. But no, that's why I go slow. I have my swing trading. I work it over the annual basis, and then I see how we go at the end of the year. That's the best way to do it. And of course, in my case, it's a bit more relaxed because I have the plan B and I have the investments and that sort of thing. So, you know, if there's a big difference in psychology between someone who has enough capital and trades a small amount, and then it loses, and you're okay. Well, it's fine. I've got some more. It's okay. We can do that. We can get it back. But if it's the last amount of money you've got in the world, let's say you've got $50,000 and you put it all in the market and it starts losing. The trouble is the psychology on that is insane, because that's your last money in the world, and it's getting sucked away. It's getting taken away. Let's say you're $10,000 down on that $50,000. How are you going to feel about that if that's the only money you've got in the world? You know, that becomes difficult. It becomes really, really difficult. And that's the psychology, and that's where the fear comes in. That's where the pain comes in. That's where the worry comes in. And some people are trading with maybe $1,000 or $500 or $5,000. That's all the money they've got. And then they put that in the market, put $1,000 in the market, you lose $500, you've just lost half your wealth. And you're thinking, what now? You know, now I can't even buy petrol for the car. It's, you know, you've got to think about that. It's quite tricky. The psychology behind it is insane. Okay. Yeah, I have passive income and use trading for additional income, which is effectively what I do, Nick, in a big way because of my investments. The investments pay, they're always there. And the trading has always been a kind of additional income, always. I've had businesses in between. I've had shops in between. I've got all kinds of things going in my life. I mean, I couldn't just sit at home all my life. And this has always been an additional income. Until recently, until a few years ago, I just stopped having businesses and I just trade. And but I do have the investment account, which is there, and it's there holding you up. It's like a cloud holding you up, or a pillow. You know, it's nice. Okay, so that you can do. And yeah, you just got to keep yourself busy. That's important. Because like I say, you get bored. But if you're a young man, if anybody here is young, but I doubt it, but anybody who's young, start investing now. Don't wait. Don't wait. Don't be hanging around waiting. Take your money and start putting it in shares now. Start building it up and put more and more in every month. Just grow it, grow it, grow it, grow it. You'll look back and you'll think of me. I'll be long gone. In 20, 30 years' time, you'll look back and say, wow, so good. Just start an investment account if you don't have one with shares, not crypto, shares. And start buying shares, but good ones, not penny shares, good shares. Amazon, Nvidia, Coke, whatever. Just buy those. Okay? Banks, buy the banks. And split the portfolio up. Don't make it all one thing. Don't just buy banks and nothing else. Buy some retail, buy some banks, buy some commodities, and buy some mines. Split it up a bit. And then mix and match and, just keep adding to it every month. Let it grow. Over the next 30 years, you'll be retired. In fact, 25 years, you'll be retired. Totally retired. You'll be sitting back, you'll be trading for fun. Okay? Val is right. Investing long term is the better option. It's always been the better option for me. It's the reason I'm sitting here calm and relaxed. It's because I have that. It's the whole point is investing is the best way to go. And when I was younger, every older trader like myself used to say to me, Rob, it's time in the market, not timing the market. Stop trying to time the market. And I used to think, you old get lost, you don't know what you're talking about, man. I'm a trader, I'm going to trade. And that was the biggest mistake, is not listening. Because if you listen and you start listening to them early, you'll have that much more when you get to ages like mine. So, yeah, that's a lot of young guys don't listen and they don't understand it. But the one thing it did do for me, is besides having the investment account and listening to them eventually and building that up over time, is also I realized that you can't time the market. And I thought, what am I doing trading if I can't time the market? What am I doing here? I mean, this is silly. I can't time the market. How am I possibly going to trade if I can't time this? I don't know whether it's going up or down. How do I work with this? What do I do? And the aha moment came to me with that. When you start investing and you've realized how much investing can do for you, then you realize, but I can't time the market, but I can put a strategy in place which gives me the ability to manage the market. In other words, it doesn't matter which way the market goes. I just need to make more. And that was the big flash for me. If those old men had not told me to invest, if those old men had not got me to invest, if those old men had not told me that it's time in the market, I would never have figured this out. I would never have figured it out. Because I wouldn't have realized that you can't time the market. Most people don't realize that you cannot time the market. Everybody still thinks that they've got some amazing system that they've invented that can time the market and will win them more trades than they lose. And they'll always think like that until such time as it bangs them on the head, and they realize, oh, hang on, there's something else I've got to do here to make money. Actually, David, you are quite correct in saying rule 1, save 10% of your income, do the same as the rule 3, do the same, rule 2, and so on. But interestingly enough, David, and you might find this insanely interesting, is I never needed to actually save 10% of my income on the investments over the 30 years. Okay, the investments were only about 20 years because I was stupid and it took me about 10 years to realize that. But okay, yeah, let's not even talk about that, shall we? But, but by the same token, I didn't need to put 10% of my income into shares. All I needed to do was put about $1,000 a month in. Interesting, eh? No matter what income I made, no matter what the month was like, you don't have to put 10. You can. That's a great rule, because if you put 10% in, it's going to be insane. But if you just put a small amount every month into the account, into the shares, and you just reinvest it, just leave it there over that period of time, you'll be amazed at how much comes back. I think I've shown you guys on the calculator before. I'm not going to bring it up now, but it's crazy. It's absolutely crazy. So you make millions just out of that small amount every month. So you don't even need to put 10% of your income away. You don't even need to do that much. You don't even need to go that far. You just need to put a little bit away every month into that account. And if you make a windfall anywhere and you get a bit of money in from somewhere, a bit of good profit, just take it and put it in there. Instead of putting it in the bank, just put it in there. Put it in the share account. Just put it among the shares and just leave it. And like I say, I don't even use charts there. The time in the market really does work. It really does. It's a big thing, eh? That's what made Warren so wealthy, but he obviously did it better than I did. But yeah, okay. Maybe longer. Yeah. Exactly, Danny. That's the whole thing. But you know what happened, Danny, to me is, like I say, 30 years ago, when I started trading, 33 years ago, I did get the advice, and I got the advice for years after that. But it took me a long time to do it. I ignored the advice. So I really only started investing just over 20 years ago. And that was my mistake. I should have started 30 years ago, but I thought trading. I'm just going to trade and buy in and out of the shares. Because when I started, that was the mistake, is when I started, they said, invest in the stock market, but don't just buy and forget it. You know, you need to buy it low and sell it high. That was the trick back in those days. So I thought that it was all about trading. It was all about buying and selling. So every share that I bought, I effectively bought and sold. So I was effectively trading for the first 10 years, such. And then the realization came to me that you needed to invest and leave the share money in. And you needed to tweak things a bit and change things around. And by then technology had come in and all the rest of it. So things started to change. But in the beginning, it's that picture in your head was buy low, sell high, buy low, sell high, buy low, sell high. So it was always buying and selling. But you can't time it. And that was the thing. I didn't realize that you can't really time it. I thought you could. And then many years later, I realized, I know, you just leave it in and forget about it. But yeah, I wish I'd right from the beginning just left it in and forgot about it, because that would have been insane. But okay, so you're 10 years off. It's fine. It's not a big deal. It's still good, and you know, it grows at an exponential rate. So yeah, it's fine. It's not a big deal. The S&P 500 is starting to make little red candles, man. You see that? It's starting to go red. Look at that little move there. So that's starting to turn around now. So this is starting to relax. So there's a good chance it might start coming down a little bit, man. The random channel, what do you think about volume trading? I think I did mention it earlier in the show, where I said that volume trading is not trading. Volume trading is, you can use volume to confirm a move, effectively. That's all you can use volume for. Ooh, look at that. This candle needs to close. You can use volume to confirm a move. So you want to see that big candle. Is it a good move? How's the volume on it? But for currency, forget about volume. Don't bother with volume on currency. It's a waste of time. But if you want to use volume, use it on indexes, use it on shares. You can use it on commodities as well, kind of. But Forex, it's a waste of time. I think even crypto, it's a waste of time. You can't use volume for that. But all that volume can do for you is tell you if a move is good or bad. That's all it can really do for you. And all it does is take up space on your chart. Really, you don't need volume to trade. how many times do you look at a volume profile, look at a trade and say, oh, that's completely off. That's not going to work. I think the percentage is really low. So no, I don't bother with it. It just takes up space on the chart and I don't need it. Like I said, if you want a good indicator of what's happening in the market, use the RSI. It tells you a lot about the market. It tells you a lot about the movement and the volume. Just use the RSI. It's best. Volume doesn't give you really enough information. It's not something you can actually take a trade with. It can, no, it's not good enough. You might as well just use price action. The Joe average needs to save 10% starting young. Give folks time in the market. Traders fall into slightly different category. Gold is falling on the 15-minute. Gold is falling on the 4-hour. And so is the Great British Pound, United States dollar. And do you see why? You see here the US 500 index is also falling. Look at that. It's falling. It's on its way down and it's falling, which tells me that things are a little bit iffy. Things are not as rosy as everybody thought they were. And you'll probably find that the dollar is moving around a bit as well. See how that looks. Oh, that's a bit slow. That was ETH. Let's check what the DAX is doing. Maybe. Maybe it'll show us what the DAX is doing. I don't know. DAX is falling off a little bit. Not too bad, though. Not too bad. Let's just... there we go. I think the servo on this thing is a little bit of a mess today. But this is a bit better. That's a bit better. Brent crude oil is moving up. Look at the Brent crude oil. That's moving to the upside. That's doing quite well. Gold needs to close that candle because then what we called this morning with short might actually start to play out. Might actually start to go, interestingly enough. And the Great British Pound as well. This candle is really moving and it's not closing yet. It needs to close so that you can get a trade off of it. Sure. Interesting though. Interesting move. Because that's quite a big move. So everything's taking a bit of a knock. Aha, the world's upset. Look at that. Yeah, I love it when that happens. What I said is all of this profit was baked in. It's been baked in for a while now. Everyone was expecting the rate cut. And now there's a few other things coming into play which are changing people's opinions and views on these rate cuts and what have you. And there's something else going on now. So gold looks like it might become a short, and the British pound, United States dollar looks like it might become quite a decent short as well for those of you who are looking at that. It looks decent. Looks like a nice run. Okay, guys, I'm going to be on my way. Going to head out. Time for me to go and enjoy the sunshine. It's afternoon here, but for you guys, some of you might be in the morning having coffee, but for me, it's afternoon. And going to relax a bit and enjoy it. The Random Conan channel asks, should I focus on one asset? No! If you're day trading and trading on 5-minute charts, focus on one asset. But if you're swing trading and you're looking at, how can I put this to you? If you're looking at trying to position your trades, then don't focus on one asset. Focus on all the assets. So guys, I'm going to be on my way. And I want to thank you for watching. I want you to keep your feet on the ground, reach for the sky. Don't forget to come back and watch tomorrow's training video. Enjoy your weekend. Come back on Tuesday for the next live show. We get together again and have a bit of fun. For all the members, I'll speak to you in the morning again. Have a great afternoon, great morning, great day, whatever it might be. Enjoy the trading, make lots of money, and I'll chat to you soon. It's time for you guys to get on your charts and start watching that that especially that S&P 500, start watching the moves and start getting into your trades.